Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, January 12th, and I'm recording this from our studio in Purchase, New York. No one can claim that the results for the U.S. equity markets in 2025 were not impressive, with a price return of 16.4%, marking the third consecutive year of double-digit gains in the S&P 500 index. The most impressive part was, of course, the historic rally of more than 40% from April through October, driven by the boom in generative AI CapEx and the resilience of the U.S. consumer. The consensus is that 2026 will be another good year. In fact, strategists' forecasts for the S&P 500 at year-end are tightly clustered between 7,500 and 7,800. Given this outlook, it may seem straightforward to lock in your exposure through passive investments and assume that the rising tide will lift all the boats. However, we believe that this approach may be overly simplistic. The top 10 companies in the S&P 500, which include the Magnificent Seven, still account for more than 40% of market cap and have dominated its performance for the past 3 years. Yet among the Mag 7, only 2, in fact, have outperformed the index last year, compared with 5 in 2024. What's more, the index itself has been struggling to break out of a range for the past 2 months. When we look beneath the surface, stock rotation has been very active. Cyclical companies have actually been trouncing defensives. Value style has begun to outperform growth. Small caps have been catching up with large caps, and once forgotten sectors like financials and healthcare have actually started to shine. In fact, the equal-weighted S&P 500 has been outperforming the market cap-weighted benchmark for at least the last 2 months. So what's going on? We think the market has started to deconcentrate or broaden out from the top 10 companies, and we see 3 reasons why this will persist in 2026. The first is earnings growth. Tech sector and Mag 7 earnings growth are now forecast to slow from the current range of 30 to 35% to 13% by the end of the year. Meanwhile, earnings growth for other companies in the S&P 500 is expected to accelerate from around 6% currently to 19% at year-end. Second, stock buybacks from the tech giants, which have typically added as much as 3 to 4% to total annual returns, are apt to continue falling as more and more of their operating cash flow goes to capital investment. Based on current guidance, around 60% of operating cash flow at the hyperscalers is being deployed to CapEx budgets, and that is expected to reach 80% by the end of this year. Finally, with the IPO market opening after a long drought, we may see some of the largest and most capital-hungry Gen AI companies tap the public markets and actually crowd out the mega-cap tech companies. In our view, these dynamics should keep the gain in the passive S&P 500 index to under 10% this year. However, they should also provide opportunities for outperformance for investors who take an active approach to stock selection. We suggest preparing for new equity index leadership and for better liquidity opportunities in private markets. Consider rebalancing for maximum strategic diversification and avoiding single-name concentration. Take profits in high beta, unprofitable, small cap, micro cap, and speculative equities and redeploy it to large cap core and quality names. We favor broadening to Gen AI productivity beneficiaries, which are likely to be in financials, healthcare, and energy sectors, in addition to adding to rest of world equities, focusing on emerging markets. Also, plan for 2026 vintage deployments in venture capital, growth private equity, and private commercial real estate. As always, thanks for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.